This is an Uncovered Japan Company research report on Muromachi Chemicals, ticker 48A5. It is a small Japanese company whose investment case rests on two businesses: pharmaceutical ingredients and specialty chemical processing. At the report date, Muromachi traded on a forward PE of 8.1 times and roughly 5.5 times EV to EBITDA. Those multiples look low, but they sit alongside thin liquidity, customer concentration, and a large margin buying overhang. In pharmaceuticals, Muromachi sources active ingredients internationally, then synthesizes, purifies, and tests them in Japan. In chemicals, it supplies and processes ion exchange resins and membranes for water treatment and industrial uses. Both engines depend on purification know-how. Pharmaceuticals represented 48% of fiscal 2025 sales and earned a 14.7% operating margin. Chemicals were 36% of sales, but only recently turned profitable. Meanwhile, management is exiting the loss-making health food business to focus resources on the two remaining engines. Revenue rose from 4.94 billion yen in fiscal 2021 to 6.65 billion yen in fiscal 2025, a 7.7% compound annual growth rate. The fiscal 2026 guide was 7.7 billion yen, although the reported numbers are temporarily flattered by the health food business before its exit. Muromachi does not have the scale or R&D budget of a large chemicals company. Its advantage is narrower, combining sourcing with regulated processing for APIs and owning uncommon equipment for resin regeneration, drying, and pulverizing in specialty applications. Management raised fiscal 2026 guidance twice, taking operating profit guidance to 700 million yen. The next comparison will be more difficult. Fiscal 2027 loses the revenue of the exiting health food business. So the key question is the underlying margin and growth of the two continuing segments. The stable theme is API supply security. The company can both import and process active ingredients domestically. Chemicals add semiconductor demand today and PFAS removal potential later. PFAS is important to the upside case, but it is not yet a material earnings stream. Management's Vision 100 plan targets 10 billion yen of sales and a 10% operating margin by fiscal 2031. Reaching it means replacing the exited revenue and then compounding the pharmaceutical and chemicals businesses, particularly through higher-value chemical applications. The company's year-end PE has ranged from 6.8 to 19.1 times. The current multiple near 8.1 times is below its own historical average and below the peer median, but it may already reflect the expected fiscal 2027 earnings dip. The report's fiscal 2029 illustrative range runs from 399 yen to 1,852 yen, with a base case near 1,042 yen. This is not a price target. It is a way to show how sensitive the outcome is to chemical growth, margins, the PFAS ramp, and the market multiple. Muromachi Chemicals is a structurally improving but difficult microcap, a profitable API engine, a chemicals business with real policy tailwinds, and a valuation that looks inexpensive on earnings. The risks deserve equal weight: low liquidity, concentration, a near-term earnings trough, and an overhang in the share register. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.